Henrik, thank you very much for joining us today. Since the last time we spoke in September, so much has happened. It's just crazy how much news has come out here in the last few months. But we had a U.S. election, and of course, it can only be characterized as being historical in nature, with the Republicans taking not only the White House, but also the Senate and the House. We've had another 25-point cut by the Fed, and we're pretty well through Q3 reporting season. And for the most part, the numbers were pretty good. What's your take on the U.S. financial markets? Are they ever going to stop going up?
Oh yeah, they're gonna stop. They're gonna stop going up, and we have all the things that everybody wanted them. Right now we have new all-time highs also in Bitcoin, and Trump got elected, which I've been told will be good for the markets as well. So what's not to like? So yes, of course, everybody will feel good about what the markets is doing right now, but they will stop going up at some point.
So the last time we spoke in September, the S&P was at 5,600, and now we're at 5,900, give or take. Your target at that time was 6,100. We're very close to approaching that. Do you still have a 6,100 target on the S&P?
I think I said 6,100 to 6,300. That was the target because there are different levels, Fibonacci levels that I'm using and working with, and probably going to be at the top end of that. So because it's been moving up quite fast of the of late, as we can see. But yes, that is the level I'm looking at. So another is it 7% for the S&P from this level, and maybe a 10% more on the Nasdaq.
And you also said you're looking for a blow off top. You still think
Yeah.
that's going to happen?
I think we're in the midst of it. I mean, again, if you look at some of these candles here and how they've been developing, and just looking at a monthly or and also November here, I think it's going to be fantastic a month. We can just look at this last week here. It was a great week also. So I think we are in the midst of that. And again, when I talked about a blow off top, it was when we were at 3,600. And I said 5,700 to 6,000. That was the estimate back then. Now then I later on I said 6,100 to 6,300. And that is the very, blow off top. And also, if you look in other markets, there are markets that have been going up by hundreds of percent in the duration of a couple of years. So this is the very blow off top that we are in. What we need to see to be this, to have it the full, is to see some of the to see crypto also come to a full blow off top. And Bitcoin is now leading that way. And I think we're going to see that into December. We're going to see a fantastic rise, and I think November is going to be fantastic.
And what's your timeline associated with this blow off top for the S&P?
So yeah, this is one thing that people come to me and say, "Oh, but you said that it should be this time or that time," and I said, "Yes, sure." But I all along said it's going to be 6,100. I said 57 to 6,000, and but then I said 6,100 to 63, and I maintain that. How fast we go up is another matter. But actually, it seems like I don't think we have much time. I don't think we have much time. I think we have seen the tops in the Nikkei. We saw that in July. Sorry, it was July actually. Not seen a new high ever since. We have seen that in potentially also in the Nifty, in the in the Indian index. We have seen it also potentially in the Sensex. We have seen it, which is also Indian. We have seen in the Danish small open economy, like the Danish economy has very, very likely put in a very big top. And I think also the German index may have a little bounce more, but also very, very close to it. But the world around us is actually starting to see that it's or starting to see see those tops here. So I say, yeah, I think we have a month worth more, a month and a half more, and then we'll be back. We'll be at the top.
So let's talk about the Fed now. And the last time we spoke, you've said this a few times, but you think the Fed is way behind the curve. They cut
Yeah.
by another 25 basis points. So that's two cuts now that add up to 75 basis points. What are your thoughts on what the Fed did?
Well, again, I think it's unbelievable. It seems like they're never learning. I mean, they do the same mistake over and over again, and they apply the same kind of tool set on the way of looking at the economy. Back in October 2007 and in December of 2007, they were talking about inflation pressures. Try imagine the month of the greatest deflationary bust, the beginning, the recession began in 2007. In Fed was talking about inflation pressure. What is going on? I mean, what is it that they are looking at if they cannot see a recession that actually started? So what the Fed is doing now is the exact same mistake. They have an economy that has been slowing, and if you look at the labor, the labor market, the non-farm payrolls over the year of 23, a number of 1.5 million jobs has been created over the first 10 months. Last year, the number was 2.5 over the first 10 months. So we have a considerable slowdown in the number of jobs being created. And that is when you look at the NFP numbers. And actually, then we had a 12,000 number in October, which is very low. Might come out as a negative number already, I mean, because we'll see the revisions. We have seen major revisions to the NFP numbers. And we know that also we have had this election year, and there have been a lot of governmental employment, put in. So I will take those numbers with a grain of salt, and I think that it's the situation is much worse than it actually looks on the surface. And especially if you look at the household survey compared to the NFP numbers, the two surveys, and you do that, the one with household is where we actually ask people that, did you get a job? And this comes out, I think, is 60,000 respondents, and the other one is 140,000 respondents, businesses that they talk to. And these two are just showing a quite different number. So if you look at the one of them, it shows like there's 700,000 jobs been created in this year, which is the household survey, and the other one shows 1.7 million. 1.4. So 700,000 difference. So again, there's something that is not quite right here, and we keep seeing these revisions on the non-farm payrolls, and yet the Fed in last night also talked about risk of inflation. So what they do not understand is inflation is a lagging indicator on the economy. So when you see the leading indicators, like for instance, the yield spread crossing over, getting a inversion, then you don't get a recession immediately, but you start to see the deterioration of the economy. And you should then look to the labor market for that. When you start to see that deterioration, which we now do, and we see lower and lower numbers, we had a 78,000 number in, can't remember, it's July, and then you had a 140, 16 or something like that, or 114, I think. And then you had a 223, which also was revised this month, and then the 12,000. I mean, they have to look at these numbers and say, okay, we now actually see this deterioration in the labor market, but yet they cut by only 25 basis points. And we have an inflation level at 2.4%. The very month before we went into a recession in 2007 and 2001, the inflation levels were way above that, above that. And we had even a stronger number also on the NF payrolls than what we had now. Why on earth the Fed does not see this deterioration? It's a mystery to me. But they are looking at the same way of doing things. And hence, if you do the same thing over and over again, how can you improve? So I say they are way, way, way too late. And that we are not in a recession at this point, and we probably not be it in December. But when you have the business cycle crossover that I observe, and that's a recession signal coming out in 23, you have had the yields starting to decline strongly first. And yes, it's been bouncing in October, but the yields are down strongly actually from the highs in May of this year. And you also have now the deterioration in the stock market, where you actually see that the momentum, the strength of the stock market, even though it rises, the momentum below is actually weakening. When you have these three things, and you still think that inflation is a problem, and you just keep maintain the rates this high, it's a mystery to me. But honestly, I think, I don't know what they do. So I'll say yes, they're doing the same thing that they've done over and over. That's being too late, and they are way too late this time.
I can only assume that they don't want to make another policy or like they did back in 21 when they said inflation was transitory. And then by March of 22, they realized they had a real problem on their hands when inflation exploded to 9%. And I can only assume they don't want to do this again. So they're being very cautious.
That shows that they don't understand the very nature of inflation. The very nature of inflation comes because when we had that in the Corona crisis, you were shutting down supply chains because people were going home. They had to go home. They were, shut down. And then you stimulated the economy. So what happens then? Everybody got a paycheck in their hand, or some kind of check in their hands. And we also got it here in Denmark, and we got like, I don't know how much, but it was, quite considerable. And what did people do? They spend it. What happens then? You send all this money into the system at a time where the supply chains are limited or closed down, which means that then you're going to get inflation pressures. That's the situation you had then. What you have now is that you have capacities built out because of the corona stimulus. Every business thought, oh man, we're doing great in 21, 22. Let's just, build business. Let's hire in some more people. We could see that in the open market positions as open. It was just, it skyrocketed. And we see also that build people, the capacities will build out, businesses all around the world. So what you have now is you have overcapacity at a time where demand is now pulling back because the stimulus is not there anymore. So now you have the opposite. And then the Fed is supporting that kind of deflationary pressure, which because when you have too much capacity and the demand is gone, then you get the opposite of the inflation pressures. Then you get the deflation pressures. And now the Fed is supporting that by keeping the rates too high. I mean, yeah.
So you don't think inflation is an issue right now? I want to take the other side of this argument because we recently saw some data out of the US where we saw the US unit labor costs were 1.9% versus expectations of 1.1%. Also, productivity was 2.2% versus expectations of 2.6%. So costs are up, but productivity is down. And this is the same sort of thing that's been happening in Canada for many years now. And then when you look at a number of major unions have renegotiated contracts here in the past few months, the longshoremen, West Coast longshoremen, they got a 32% increase. The East Coast longshoremen, 60%. Boeing mechanics just negotiated a 38% increase. And all of these higher wages are going to trickle down to the consumers. So you're not concerned about this?
Yeah, but again, that's also what we see every time. It's because inflation is lagging. So first of all, you see that when you stimulate and you see this boost up and you get the inflation coming up, you will then see that all the unions and so on start to have these negotiations, and time passes before it actually starts to trickle down to the workers. So yes, it's going to affect us also that we see this. But it's the problem is that right now it's the deflationary part of it that we because there's no demand right now that can support the kind of build-up of capacity that we have. So yes, inflation is coming back to haunt us, but it's not right now. And again, the Fed is now helping to pressure the deflationary pressure to make that even bigger by the policies that they're following at this point. But again, that's where we have got the fluctuations that we saw after Corona with everything going so fast. That first now we'll see some deflationary pressures. The Fed will be behind that. Then when inflation comes in again, they will also be behind that because then they will start to stimulate. And that's also why I think they're going to do. I mean, they are in the midst of a policy error. They are doing a policy. They are making a policy error as we speak by keeping rates so high, and they will do once again in the future because they are following inflation, and inflation is a lagging indicator on the economy. I mean, I will have this written on my gravestone because it's something that is surprising to me that people really don't understand. It's like inflation comes after, so you cannot follow that. If you want to follow what you need to do, you need to look out the front window of the leading indicators, what is going to happen now. And if you look at things like oil and commodities and so on, oil is not expensive here. Oil has been dropping and has actually technically dropped out of a technical structure, which suggests to me that it's just standing in front of a big move here to lower, much lower. So if they looked at that also, and they looked at the delinquency rates around the world for different loans and credit cards and what else have we, I mean, the consumer is struggling in the US and the rest of the world. And that's why that they keep this high and saying, oh, inflation is a problem. By that, they kill the child. I mean, they kill the child by strangling the economy at a time where it's actually rolling over because they are watching and observing things that will follow. And that's why it becomes like such a late thing. So I was in disbelief yesterday, and you probably could tell that from my tweet, also saying this is like seeing 2007 again. They do it exactly the same. They talk about strong growth with 12,000 jobs created. And then they say, oh, yeah, but that's because of hurricanes and so on. It's not just about the 12,000. It's about the household versus the NFP report. It's about the trend also in 2023. So I understand. I mean, I'm just in disbelief with what I see from the Fed at this point.
Yeah, and you mentioned that non-farm number for the month of October, and I'm sure when we see a revision here this month or next month, it's going to be negative. So that's going to be interesting also.
Yeah, absolutely. And again, that you have a trend that has been clearly been trending down. I mean, to what point does the Fed needs to keep the rates high when they can see that the trend is trending downwards? and that they do not understand and realize that there is also a time lag from the moment that they start to do something till the moment it actually gets through to the consumer. So it's not like when, we heard something yesterday, they cut by 25, 0.25. We say, oh, now we're going to spend some more money today. Not happening. It takes a while. Maybe we will reconsider some of our loans and so on. But we are so much closer to the point where the economy is starting to run backwards. So I don't understand why they're not in a bigger hurry. They should be in a much, much bigger hurry. And I think they're going to panic cut again, like they do every time, because all of a sudden it becomes clear to them, oh, we are actually heading into a recession. Or what happens most likely is that we get that kind of black swan event because we start to see a souring of the financial sector and so on. And I think we are getting close to a top in some of these in the financial sector in the US as well and elsewhere. So I think that the worsening of the situation for the consumer, where unemployment becomes a bigger thing now because not so many jobs are being created, and will then make it worse for the financial sector. Then we're going to see some more fallouts from that, and that is going to then trickle into a deflationary bust, which is going to develop into next year.
Yeah, and I think that's the other thing that really distorted the jobs numbers this year was the fiscal spending going on by the Biden administration. They were spending trillions of dollars just to keep the economy going, and with the hopes of staying in office. But that didn't
Yeah,
work
yeah,
out.
exactly.
And I think a lot of the money they spent on a lot of the jobs that were created weren't real jobs.
Yeah, and again, you're probably closer to this than I am, but I was wondering what I saw also when I think it was in September. All of a sudden, there was a government new government jobs. It was like 10 times up the largest numbers we have ever seen in every month of September, going back to 2000, yeah, to the year 2000. So for the last 24 years, you've never seen so many jobs created in the governmental sector. So something smelled of something, and I'm not wearing a tinfoil hat here, but I'm just saying it seemed like some of these numbers was propped up to a certain, or maybe it's because people were actually hired in to do something around the election. I don't know, but I just think that a 10 times bigger number than what we've seen 20 years, 24 years back in the same month has a smell to it.
So you touched on oil, and I would agree it's been weak all year. It's stuck in this range of $70 to $80 a barrel, in spite of what's happening in Russia and the Ukraine, and also with these hostilities in the Middle East. And I almost think if we didn't have these events going on, that oil might be at $50 a barrel. What are your thoughts? Where do you see oil going?
So I think oil is standing just in front of a bigger decline. Actually, I think we technically, as I see it, we had a small bounce again now here and may bounce up to where we were just in October, just once more, really quickly. And then I think we're going to go down, and I think it's going to be quick. Technically, we're broken lower, and again, in an economy that is rolling over, as my business cycle tells me, then we are not going to see a strong demand for oil, and that means that the oil is going to drop rather fast. And well, that is the normal thing we see. We also saw that into 2008. In 2008, we saw a very strong decline in oil because that is part of the deflationary pressure when people are starting to feel the heat of that they can lose their jobs or they have lost their jobs, and yeah, maybe also the stock market tops out, which I think it will also, and then you'll start to see that these things can develop. So I think oil will have a very big drop, and I think we can go down to around $10 and maybe even below.
That's a significant pullback.
That's a crash.
Like that, but
That's a
that would
crash.
imply
That
if you see oil at $10 a barrel, that would imply the US
a very big
economy is
crash.
going to also crash.
But right now we are sitting in the on the biggest bubble we have ever seen. We have a Fed which is have kept the interest rates way too high. We have a euphoria in the stock market, and it seems like every kind of narrative goes around that about why it's so why. And again, remember what I said when we talked some time ago. I said we're going to see this euphoria, and that's now starting. That's now beginning, and we got a situation where the business cycle is telling us that the real economy is rolling over. At least that's how I see it. We see the unemployment rate and the number of unemployed people. Even if we look at the initial claims here, it was a low number again yesterday. But if you look at the continuing initial claims, then there's actually very clearly climbing every week, and was again this week climbing more than what was expected. And it's certainly made a round bottom, and just like what we see into every recession. If you look at the labor market from a perspective of how many weeks, what is the average length of unemployment, you actually see that that's also climbing again now, which is also what you see into every recession. And actually, if you look at that, it's higher now than it's been at any point going from 1940s until 2009. 2009 was when it spiked into the financial crisis. It's never really gotten below any of those levels. It was below just for a short while. It came back up again, and now it's rising again, and it's way above those levels. That is structural unemployment. That means that people are unemployed for longer. That is not a strong economy. That's the opposite of a strong economy, because people that are unemployed for longer lose their connection to the labor market, which means that it will be harder to get them employed again. So this about a strong economy. Look just look under the hood and then see these small things here, and then say, okay, where are we really going with this? And actually, if you look at it, when the Fed starts to cut, it's not because things are great. It's always because things are starting to sour, and it's just a matter of will they catch it before we actually, or will they not? And I say they are no way they'll catch it. It's way too late.
So I just want to go back to oil because $10 seems outrageous to me
Wild.
because even when we look at 2020, okay, in Q1 of 2020, oil got down to $25 a barrel, and that's when COVID really set in throughout the world, and essentially the entire global economy shut down for a short period of time. But at that time, the low was $25 a barrel. How do you get $10 a barrel?
So that I'm talking about crude oil here, and crude oil should that's the one I'm talking about. And I think, well, it's part of the extensions that I do, and the Fibonacci's and the modeling that I do. I see a very limited demand on oil. It's about supply and demand here, obviously, and again, we've seen how the oil can also go to negative in a short amount of time. And I think what you can see that is within a deflationary bust, when the world doesn't come to a standstill because of disease or a virus, but comes to a standstill because, or almost standstill because of the economy actually, it's things just getting worse and worse. And the other thing is, which nobody accounts for at this point, is that the environment that I'm talking about, we're going into right now, we are in right now, is a toxic environment. It's an environment where the consumer is not feeling good. And we have seen also how the financial markets have, major and many times bigger unrealized losses on their books than they had before 2000 and in 2008. So if some of these things starts to evolve and we get a black swan, it's just a matter of time. Then you'll see a black swan event coming up in this kind of toxic environment. Then, you will have the rollover. Let's say, and I don't want to mention any names here, but one of the big banks in Japan, in somewhere else, maybe rolls over because of the toxic environment. And we know there are problems in Japan also. We can see that. We saw that in August. I mean, people just happily forgotten about that. But there are things there that is not well. The financial institutions were down 25% in a day, came up, bounced. But let's see if it's not just a bounce and we're rolling back over again. That's what I say. And if I'm right on that, you could see a lot of fallouts from that. And these fallouts are something that you cannot discount for right now, because you and I cannot sit here and say, oh, but there's an indicator saying here that this or that bank has a problem. But what we can say is that the consumer is struggling. We can see that delinquency rates are going up really fast. It's not just among private consumers, also among companies. And that is the problem. That is what creates the toxic environment, which will create a black swan. And that's why when we sit here and talk about, oh, but $10 can be, who would ever guess we could see oil going to negative at one point? Who can then say, okay, couldn't we see in a very bad bust that we could see oil going to around $10? And I maintain that view. I think we're going to go down to that point, to that level during 25, early 25.
Stanley Druckenmiller recently gave an interview. I would highly suggest anybody check it out. It was a great interview, lots of insights. But he said the biggest threat to 2025 is a pickup in inflation. And he actually compared to 2025 to the 1970s, where we had this big pickup in inflation. It rose up to 8%. Then it pulled back to 3%. The Fed thought they had it under control, and then it just accelerated it again. And what are your thoughts on that? Do you see that happening?
Short term, he's wrong, I think. Long term, he's right. So I think that, just comparing to 1970s is like, okay, we just jump to a decade and say this is where we were at. This is like, no, because the big cycles are that we go to extremes. So we had an extreme in 1981. We called it the Volcker moment, and he killed it in inflation by hiking rates. It actually was something quite different as I see it. But anyway, and then we have had a 40 years kind of decline in inflation and rates also because they follow the inflation. The thing is, we are not now in the 70s all of a sudden. What we are in is we are in a sort of environment we were when this inflationary move up began. So it was in the 50s when we started to see the move up, and we didn't see a spike up like this. What you see when we have inflation rates going up is that they are rounding bottoms. Tops are very often a very spiky top, and they come down strongly. But the bottoms are something that takes time. Why? Because a lot of people have a lot of debt. So inflation cannot just soar up like that. So it has to come down and also to meet, because otherwise there will be, there's no push in the inflation. So secularly, on a secular basis, we have seen the bottom there. We are in a new inflationary regime, which means that inflation from, if you look at from where we were 2 years ago, let's say 4 years ago, will start to pick up and continue. But if you look at today and you look at the next 6 to 9 months, 12 months even, I would say that inflation will be heading down and rather strongly because of what we see in oil, because of the recession setting in. But what he's right on is that there is a new inflationary regime, which means that when we look at these cycles here, is that we have now crossed past the bottom on inflation, as I see it. We've moved up the first. It now comes down in the second, which will not be a new bottom in inflation, and then it moves up again. And that's why everything we have learned over the last 40 years, we can take and throw out the window in terms of how to invest. This regime we're getting into, not in the next 10 months or 9 months, but after that, what he's talking about, we have to understand from a perspective of what happened from the 50s into the 70s. That I agree with. But I think short term, with the rollover of the business cycle, the inflation being a lagging indicator on the economy, and we were starting to see the fallouts. And again, now we need to see what I'm talking about here. That is what is really driving things, and that will drive inflation and rates down first very strongly, and then we're going to see exactly what it talks about, that inflation will be on a new upward secular path.
I think his big concerns were too when he said he's looking for a pickup in inflation. He says so because of the Trump administration. He thinks they're going to engage in deregulation, which can be inflationary, also tariffs, which can also be inflationary. And I think that's where he's going with that thought process.
And I agree, and I completely agree, and I think that's one thing that probably will why also we should see that stagflationary period after, because if I'm right on what I say, then see we have a bust now. We have an economy that is now starting, and we have to understand the economy as a super tanker that comes to they're starting to turn. And then at some point it's we get inflation at that point because of these tariffs, because of what we see already with also other things that could help us move up in inflation, with the vast amount of money also circulating. Then of course this is a problem for the long time frame. But again, it's about the time frame of it. So I think yes, longer time frame it will be a problem, and a very big problem. I mean, everybody who has a lot of debt at that point, when inflation moves up to higher levels, need to understand how, or need to figure out how to sustain that debt, and that also goes with the U.S.
Druckenmiller also said he is negative on bonds and he wanted to short bonds. And we just saw the 10-year go from a low of 360 up to 440. What are your thoughts on bonds and interest rates?
Yeah, so bonds, that's it's about the interest rates again, and when I say interest rates and inflation is a lagging indicator of the economy, it means that when we look at the leading and the coincident indicators that I follow, which is the real economy, if the real economy rolls over as I see it now, then inflation will come down, and then yields will come down with it. That's also what we start to see now, because we see the central banks of the world are starting to cut rates, and they do that because they can see that the 2 year yields is starting to decline in the U.S., and that is what they follow. So I think that in the perspective of shorting bonds at this point, that's a bad idea. If you do it right now, I mean, you're doing it because you see a small spike. But we seen inflation, and we've seen yields coming down from the top in May of this year, May or June, can't remember when the top was, but it is either May or June. And what we saw into October now has been a bounce. And I actually think that the yields are actually turning at this point. So we are actually seeing now this small bounce, which took away 50% of the decline we have had, which is normal. Nothing moves in a straight line. And then you're going to see it come down rather strongly here because of what happens in the economy. So if he's short bonds right now, he's going. I say he lose on that position into the first part of 25. But hopefully his pockets are deep enough so he'll be able to maintain and go through that. But probably I would not be short bonds at this point. I'll probably be long bonds at this point until at into the deflationary until the deflationary bust is over and done, which it is not by now.
Another one of the indicators that you follow is the Buffett indicator, which is basically looking at the market cap of the stock market, US stock market versus the GDP. And right now, I believe it's at an all-time high around 200%. We recently saw Buffett sell another 100 million shares of Apple. He's now sitting on $325 billion in cash. What are your thoughts on this?
I don't follow him like that, and but I notice that his lease has reduced his positions. And obviously he's good at maintaining positions that he knows will do well over the next many years, obviously. But I think that he's reducing and increasing his cash levels is also because he sees something that we could see a decline. And I just when you have euphoria in the markets, which as we start to see now, it's normally a good time to take some cash off. So I think what he does there is, prudent, and I can only say that's in line with what I see, that we're gonna see a big top soon, and then things are gonna come back down really fast. And I also noticed that he took off a lot of Bank of America shares. I think we're gonna see a financial crisis unfold, and a liquidity crisis. So having cash at that point is not too bad. So yeah, sounds right to me. I would be stupid to say anything else. I know that, but it's actually fitting what I say in terms of my models.
When you say a financial crisis, can you expand on that? And what exactly do you mean by that? And what would be the catalyst to trigger it?
So the catalyst is the toxic environment we're in right now, which means that the consumer is starting to not being able to service their debt. We can see the delinquencies as we can see that also with commercial customers. So that is a problem for the banks. And all of a sudden they sit with something where they said, okay, but dear Mr. Customer, we thought you were going to pay us back. But yeah, hey, I can't. So if that starts to become a problem in the banks, and that's what we saw in the financial crisis as well, and people say, yeah, but that's because we had a bubble in the real estate market. But guys, right now we have a bubble in so many other things. We have that in the private equity market where you have valuations which are crazy. You have, a lot of places where people are just taking on a lot of risk without actually getting any yields from it. So when we start to see that souring up of the financial system because of what the consumers is not having is not good, then all of a sudden one of the big one will start to wobble, and I think that is where we can see the big fallout. That's what happened in 2008 also. First we saw Bear Stearns in March. The Fed decided we want to save this one, and then we saw Lehman Brothers at a later stage because nothing was solved at that point. And then we saw Lehman Brothers, and then the Fed came in and said, okay, now we do everything. So I think that the now we do everything is going to be faster this time around, but I think markets can drop a lot before that. So I think that the financial crisis will come because of what we see there. There will be a catalyst somewhere, but that will actually be because the recession has set in, and that the market is starting to, the economy is starting to become a place where the jobs will be lost. People cannot pay their mortgages or whatever it will be, and their loans, and then money will be lost in the financial sector, and all of a sudden it becomes bigger and bigger, and then you have it's like a snowball just as running down the hill, and that's what causes it. And all of a sudden you see something topple, and it will then create the effects into other parts of the system, into the financial the global sector. And again, as I said, it doesn't need to be in the US. The beginning, the start could easily be in Japan, for instance. I think Japan has some financial institutions where I can see a lot of weakness, and I could think that they could drop a lot and they can cause a lot of problem for the rest of the world. So the trigger is the toxic environment, which is the slow bleeding of the economy. It's like the Titanic. It didn't sink immediately. It's not like it hit the iceberg and then just sank. It hit the iceberg, it stayed afloat, it got worse and worse, and all of a sudden it sank. That's what you're going to see here as well. And there may also be a sector just floating around to begin, but also sinking eventually. So the financial sector is the souring of the economy, which comes from through the consumers, or the customers, whether it's private or commercial. And that will then cause a lot of problems around the world, because when the financial sector starts to have problem, then we get into the leverage problem. The problem is that all the banks, they don't have all the cash that we put in there. So they just have one, so whatever the capital requirement is, but they have, a fraction of that. So the moment one or two of them falls or has started having problems, then liquidity becomes a problem. And that's the moment where you'll see a sell-off of a lot of things. That's the credit crunch. That's where nobody wants to lend money because there is a mistrust to everybody. That is the thing I can see also, that we can start to see that, and maybe the credit line will freeze also for a short amount of time. Of course, the Fed will come in with liquidity, but as we saw in the financial crisis also, even liquidity will not save the day when the things are just starting to get rolling. You need to see the full evolving of the crisis first. And I fear that's what we're heading into. I think that's what we're heading into.
Okay, so I want to ask you about gold, something that's near and dear to my heart. So you made a great call on the S&P and the Nasdaq, especially back in August when the global markets got hit pretty good, and everybody thought that was the beginning of a significant pullback, and it wasn't. You stuck to your convictions, and the market did take off. But you've been negative on gold for a while, and here it is trading at or near all-time highs. It's up 30% on the year. What are your views now? Have they changed at all?
It hasn't. I mean, in my world, it's not just about gold. It's about precious metals. So if you look at precious metals, you look at gold, silver, palladium, platinum, and so on, and also gold miners. Then I said, when I look at all of these, they look like they will stay in a bearish kind of structure. I've been right on all of those except gold. But in the way I analyze things, there can be outliers. There can be some of the models, some of these the assets that actually pops into a more what looks like a bullish structure, but it actually is a structure that will come down where you'll see a decline. I still say when the things that I just talked about, the liquidity crisis that I'm talking about right now, you will see gold decline. And there is a chance, I'm saying now, there is a chance that gold actually has top or is going to. Otherwise, I would not think gold will perform well from whenever we see the top in the stock market. So if I'm right on the top in the stock market to until the point where we see the Fed come back in again. But I have to say, I'm very bullish gold, just not from these levels on. I mean, as I've said all along, if there's a stagflation coming on, then gold and silver and so on will do fantastic. And if you look at this rally of gold, 30% in what, a year? That's not what we're talking about. When gold takes off, we take about 2 times or 200% in a year or more. So what I'm talking about, the move in gold, is not now. What we see now is actually part of a correctional structure that is going to take gold down again, together with silver and platinum and the gold miners. And you can look at the gold miners. If gold was taking off, like why are we not seeing the gold miners take off? They are not, because the environment is not right for that yet, and that will come. And if we get the stagflation right, then you'll have a fantastic rally in gold, and I'll be the most bullish one. I'll be in the front of the line of buying gold and gold miners, but it's just not now. And the 30% move here, fair. You can say it's wrong, and yes, it is. But if you look at the general precious metals, they are moving, in a more muted way. Since 2011, 2012, it's been very muted. Silver is nowhere near the all-time highs. So this about that gold has been rising. People just disregarding the rest of the thing. And yes, I was then wrong on that on the call on gold, but it will not be wrong in the way of actually saying, okay, the precious metals are going to go higher at some point, and they will go higher together, and it'll be an explosive move. But I don't see it yet. I see it later. I see it when we get to the point where the deflationary bust is over, and we have had the credit crunch. Because in credit crunch, in a dollar strength world, in a deflationary world where the dollar Dixie will go to around 120, that's not going to be nice for gold.
So let's summarize a lot of the points you made here in the last few minutes, Henrik. So once again, going into year end, you expect this blow off top where we see the S&P going to 6,100 to 6,300. Okay.
Right.
And then we're going to see, I guess, a weakening U.S. economy. And this is what's going to be the catalyst to take the U.S. financial markets lower. And I guess as the months go on into 2025, you see more and more weakness coming out of the economy, and you think this could lead to some sort of financial crisis within the US banking system. Do I have all this right?
The global financial system, yes. Yeah,
And this is what's going to be the major catalyst to take the S&P and the NASDAQ significantly lower.
significantly
And
lower.
give me your what sort of target price are you looking for on the S&P? What sort of pullback are we expecting?
So when I in 2022 said we could reach these levels here, and that was around 3,600, if I'm not mistaken, on the S&P, that was a very big bottom we created there. And I would think that the first part of the crisis would take us down to that level again, and that will be the first part of the crisis. So I think that is actually what we should be looking into. And if we remember how fast this happened and how fast, it happened in 2007, 2008, we had the top in October 2007, and we saw the bottom in the stock market. I think it was there was in the S&P, it was actually in March of 2009, and in Nasdaq, I think it was in October or November, but I'll have to check that. But that shows us within a year, 13 months, we can have the lows that we want to see, that we could see. And I would think that when we sit here in a year's time from now, in November or December next year, we would be at very, very different levels than where we are at right now. And I would not be surprised to have seen that level again at that point, December 2025. So
Okay.
around the level of and that will be the first part of the crisis. And I will not say that at that point we are there, actually. Let me just emphasize that. I will not say that we are there in November, December. I'll say that we have seen that bottom potentially by the end of next year. So a very, very strong decline.
And Bitcoin, that's basically a proxy for the market, maybe for the NASDAQ because it's quite volatile. But right now it's around 75,000. And you see that going up to 115,000 and then a major collapse in Bitcoin. Do you see that happening
Correct.
or over the same sort of time frame?
Absolutely. I mean, that's Bitcoin is about, first of all, liquidity in the system, as people say, yeah, it's correct. And people say it's about inflation and all that. I'm not really sure about that. What I think it's an ultimate risk asset, just like in cryptos, the rest of the altcoins and so on, even more so, risk on. It's like risk with, exponential. So I would say that, when you see these kind of highs here and that euphoria it will create, that will leave the door open for a very big crash. And I can only say I actually don't dare to say how low I see Bitcoin going, and I don't do that because I'll only just point to that Ray Dalio has pointed a level out that after the crisis, and funnily enough, and it's not like I'm following him like that, but I just saw that and I thought, okay, that's interesting. I have that same number. So I would say that when the crisis sets in, I think we're going to see a very, very big crash in Bitcoin. And people say, yeah, we got a hodl and all that. We have to see what comes after, because if you get a stagflationary period, then maybe Bitcoin will do well. But I can promise you that all 12, 15, 17,000 or how many altcoins that are out there are not going to do well. And in a world where, if I'm right on if you had the secular bottom in yields and inflation, and we're starting to see that moving up higher, people tend to think that's a good thing for this, but it's not. Because what you will have to sit then and think about is that, do I want to put my money in something with yields 4 or 5% with certainty, or put it into something where the only reason why this is rising is because there is a guy coming next after me and he wants to buy it for something more. So I would say that these assets here will be under tremendous pressure, and Bitcoin will also be. And I think that there is a chance that some of these can survive, and there will be a new Amazon or something coming out of them, all of these cryptos. But I cannot pick the one out. But yes, Bitcoin is going to have a big decline.
And I just want to get this time frame correct because right now it's trading around 75,000 bucks. You see it going up to 115. So call it, what's that, another 40, 45%? That's a significant move in a short period of time.
Hmm. Yeah, but if you look into the tops that you had on Bitcoin over the last many years, you will actually see into 21 and 2017, you will actually see that the 2 last months are actually the months where you see the biggest rise. And you had in, I think it was November 2021, I think, or yes, I think it was that time. We actually saw that it was, I think we had a 70 something percent move in that 1 month alone. If you look to the spike that you had, and then it pulled back to 36% around that level. So that's what you can see also. You will see a lot of move up and then they'll be selling. So yes, I think the timeline, we got another month and a half, maximum 2 months. Then I think we got the top.
So the picture you're painting for 2025 is not a very rosy one, shall we say?
Nope.
But what do you suggest investors do now? Like, especially now when we're going through this state of euphoria, if you will, and things look so good, the economy looks good, the financial markets look great. How do you think investors should position themselves?
So it's difficult to sit here because it depends on, how people are, the risk profiles and so on. So that'll be difficult. But, into a deflationary bust, you want to be long bonds, the opposite of what, Druckenmiller says, especially if you're shorting it now. So I'll be buying his shorts. Um, and then you want to be long the dollar. You want to be long liquidity, real liquidity, which is the US dollar. And you wanna not be in risk asset, and you absolutely do not want to be in the most risky asset, which are altcoins. So into a bust, you want to be that in the final phase here for the next few months, and that's how I'm positioned right now. Just let me put that clear. But it's and then you will at some point when all this selling has been happening, and the Fed starts to get back in again, then it's time for gold as I see it. So we are but in that phase also so long treasuries, long bonds, and long the dollar into the deflationary crisis, and then you'll shift, and then you'll get into gold, gold miners, and something that which does well, commodities, and I think you'll have a fantastic commodity bubble actually developing also after this when we see the bust.
And just to clarify, right now you're risk on, like your own.
Absolutely. Yeah, 100%. I mean, it's been, fantastic few days here. So yeah, I'll not lie about that, but, and it's going to be better, I think, over the next few months here. But the problem is not the problem. Think I have a good idea of when to get out. I think a lot of people will not have that good idea. And that's the problem, that a lot of people will get caught. And I can already see now, where for a year ago, 2 years ago, a year and a half ago, had to tell people will be going up now. Then now people are saying, "Oh my God, he's just this, bear, perma bear." I'm being called already. I love that because I've actually been so bullish, and now I'm just telling, okay, now it seems like things are starting to shift to the other direction, and we don't have so much more height in the stock markets as I see it. So
Well, Henrik, that was a great discussion. Always very interesting speaking with you. And if someone would like to follow you online or read about your research and get your thoughts, where can they go?
So the best thing would be to go to at Henrik Zeberg on Twitter. That's the most direct way, and yeah, and then see whatever I do, and you also reach out. I always like a good conversation. If anybody has anything to say and saying, okay, you're wrong because this and that, I'm open because I like to be challenged on my view. But yeah, let's see if that's up. So please feel welcome to interact with me.
Well, once again, Henrik, thank you. And I look forward to our next conversation.
Likewise, thank you very much, James.